Welcome to the Mainstream Mortgages podcast. My name is Peter Paley. I'm the broker of record for Dominion Lending Center's Mainstream Mortgages. And with me today are my two business partners, Colton Boudreau, who's the head of mortgage underwriting for us, and Derek Vandal, who is the head of mortgage policy administration and our compliance officer. And today we are talking about pre-approvals. What's good, what's bad, and what people need to know. So we hope you can um, get some information out of our podcast and apply it and maybe even use us for your next mortgage. So the first thing that I wanted to talk about today is just the basics. So Colton, can you explain what the difference between an underwritten pre-approval that we do versus a pre-approval that you may get from your financial institution like a bank or credit union or an online mortgage provider?
Yeah, so pre-qualification is it's just simply you're inputting your own numbers, right? Your income, your debt, your down payment, and it's just very vague. It's not specific to your situation. It doesn't take in your actual credit score or anything like that, or what you might have on your credit bureau. It creates this sense false of security for clients because they think they're approved, let's say up to 400,000, when in reality they're actually approved to 300,000. So the beauty of our underwritten pre-approval is that we'll take your application. We look at all your documents. We look at your letter of employment, your pay stubs, your bank statements. We pull your credit. If there's any issues or discrepancies, we look at it up front. We fix it if we need to. And then we run your numbers. We look at your whole overall file, and we run the numbers specific to your situation so you have a true understanding of what you can afford. And we actually tailor our pre-approval specific to each property that you're going to write on. So that way, you know the max number you can go to on 123 Main Street, for example, and it provides just a real sense of security and understanding of the process and what you can afford.
So basically, we do a ton of work up front for the benefit of our client and making sure that their income's correct, that their down payment's correct, and that there's no blemishes on their credit bureau to give them even more confidence when writing an offer on a home. Derek, I want you to jump in here from a process and maybe compliance aspect. As we're collecting these docs, what is important for us to look at for income and down payment documentation?
Yeah, so as the mortgage broker, we have to kind of understand what the lender is going to be looking at, right? And so I think a lot of people don't really know. Lenders look at your mortgage and whether they're going to approve your mortgage or not based on risk. Everything is based on risk for the lender, right? So if they're going to look at your employment, is it part-time? Is it casual? Is it full-time, guaranteed salary, hourly, all that kind of stuff? They're going to be looking at all those little tiny details, and there's a million of them. So, and that's just one example. Another one would be your credit history, that kind of stuff. And from a compliance standpoint, we're really just looking for getting your consent to pull your credit and collect your private information, that kind of stuff. If you are working with someone who isn't getting your consent for those kind of things, I would recommend you maybe work with someone else.
Yeah, I hear you on that for sure. I just sort of wanted to maybe interject with a real life example that we just recently had where a client had come to us and was pre-approved by their financial institution. They were only pre-approved up to $250,000 purchase price, which doesn't really buy much for a family, but we were able to um, increase their income by using some of their overtime, bonus income, and we added their spouse to the application when we're able to use 100% of the Canada Child Benefit. And those little differences made a huge difference in their purchasing power because we were able to pre-approve them to 350,000. And that, as you know, in our market, buys a significantly nicer house for a family than 250,000. So not all pre-approvals are created the same. And I think the point we're trying to get here is the devil's in the details, where a verified and fully underwritten pre-approval is much better than an online calculator or one where someone didn't put the effort in up front. Okay, let's move on about the rate. Rate. is king. Everyone calls what's your lowest rate? And um, we know as professionals it's not really about rate, it's more about terms and having a mortgage that suits your long-term plan and has ways to get out of the mortgage without hefty penalties. So, Colton, would you be able to explain um, when we pre-approve someone if we choose to rate hold them or why we wouldn't choose to give them a rate hold and and also why how we pick a lender and why we think that it would be better for a client.
Yeah, for sure. So typically rates, we can hold rates for 90 to 120 days pending the financial institution or the lender. Um, how we pick lenders is it's tailored to you, right? It's tailored to your specific situation, your needs, your requirements, and everybody's different, right? So we look at the whole general picture of your application. We determine what lender fits you, and not everybody fits every lender, right? So that's the beauty of our job is we have access to about 30 different lenders where we can pick and choose where we think your file should go, where we know it's going to work, and what's best for you. Things we look for when we fit these files into certain lenders is that one, we want good prepayment privileges. Typically, lots of our lenders are 20% annually. The terms are really important to us. Is there big penalties if you break your mortgage? Is there any bona fide sale clauses in it? Can you switch your mortgage if interest rates were to drop? And back to your original question about if we actually do lock in a rate for clients, we typically only do that if the interest rates are increasing or we think they're going to increase over the next couple of months. As we are right now, the rates seem to be decreasing, so we're not typically sending our clients for rate holds because there's no point in locking in at a rate of 4.09% if it's going to decrease over the next month or so. So we kind of we manage the market a little bit. We look at it every day and we make those decisions accordingly.
So Derek, as like our chief administrative officer, and when we do our morning meetings and we're going through our rate hold sheet, what's important for clients to know during this rate hold period in terms of what their responsibilities are in keeping their pre-approval valid?
That's a great question. So one of the biggest things about the pre-approvals that we provide is that they are subject to no material changes to your application. What does that mean? What is a material change? So any change that will affect or potentially affect a lender's chance of approving your file or declining. So we're talking about changing jobs. Maybe your car is breaking down and you need to buy a new vehicle. That that could mean a hefty car loan that you didn't have before. And now all of a sudden you don't qualify for the pre-approval amount that we gave you, right? So your responsibility, I would say, as the borrower, is to just keep in touch with your mortgage professional. Anything that you think might change your application, your mortgage application, let your mortgage professional know before you do it, because there could be some really big implications, and you don't want to, find that dream home and all of a sudden be told, oh, you don't qualify for it now because you just needed a new vehicle because you needed to get one and you didn't even think about it affecting your mortgage application, right? And that's just one example.
It's so true. So, I remember last year we had this happen with one of the agents in our office where they pre-approved the client. The file was golden. It was a great file. And then the client went and bought a new car. And the payment from their old car payment was $600 a month, and the new car payment was $900 a month. And that reduced their purchasing power from 425,000 to 280,000. And it was just such a big difference. And the client was so upset because even though, well, we told them, they maybe forgot or didn't stay in touch with us like they should have, and they weren't able to get to that original amount that they were originally pre-approved for. Um, and that's unfortunate because there's not much we can do after something like that, an event like that happens. So, While we're here to provide advice and we're here to help our client at every step of the way, it's really important that keeping in touch piece to make sure that there is no material change in the application and we can proceed with your mortgage without any delays. So far, we've talked about the difference between a real pre-approval or an underwritten pre-approval, and we've talked about the rate. And now let's talk about um, what's happening while you're shopping for a house. And I know Colton, you sort of touched on it before, how we want to know before you write an offer on a house so we can write you a tailored pre-approval for that address, which is very beneficial in a competitive situation. But there's more why we would do that. So can you explain to everybody why we're so diligent on trying to know all the information about the house before they write an offer?
Yeah, for sure. So we stay active in your file, right? We're always touching base, always keeping up. And like Peter said, if you are renting on a specific property, we ask for the address, we run the numbers, but we also want to take a look at the house. Is there a property disclosure statement? Is there anything that we need to address on that? Does the property fit lender insurer guidelines or just guidelines in general? We like to look at all that up front because then we determine the best course of action, what you can afford, or how high you can go. And we also like to refresh your documents, right? Most documents are only valid for 30 to 60 days, depending the document. So that way we can stay on top of you. We can ask for that updated pay stub or bank statement. So we have everything up front so we can meet your condition of finance, whether it's 2 days or 5 days. We just like to be ready to go. And that way we can start the process when you do have an accepted offer even quicker and get you on your way to getting the keys that much smoother. And also, if anything were to change in the process, like Derek kind of alluded to, if you go on mat leave or you change your jobs, or even if you rack up a little more debt, like it's always good for us to know because it does have an impact on your pre-approval, big or small. It can definitely change the outlook of your application. And so we always like to know upfront, and then we can address it as the process kind of continues on until you find that house you want to write on.
Before I throw a question to Derek, I just sort of wanted to jump in with another real life example where we are working with a client right now who we were able to pre-approve for $475,000, but they decided to cut back on their hours at work. And while they're very fortunate to have a lot of savings and life savings, that reduction in hours is reducing their pre-approval amount from 475 to $350,000. And when I say reduction in hour, it's almost 50% reduction in pay. So that income piece is such a huge component of the application, and consistency is really key while we're going through this process. So, Derek, I wanted to throw this question to you based on Colton touching on the property disclosure statement, which is available for most listings. Um, why is that important, and what are some of the common defects that could jeopardize a pre-approval on a specific property?
Um, so you're asking why the property disclosure statement specifically is important?
Yeah, and I know you just sort of had one with aluminum wiring lately, so I just thought I'd let you answer this question.
Yeah, so if there is any kind of potential defect in the home, like, for example, aluminum wiring or knob and tube wiring, and it's not in the property disclosure statement, um, it could be revealed to the lender through an appraisal or potentially other means, right? So as soon as the lender sees that there is a defect like that, they could just outright decline you, or they could require you to have that remediated before the possession date, which can be very difficult to do. If the vendor of the home doesn't want to do it, they don't have to, right? So these are things that could pop up and just completely derail your purchase of the home. So it is kind of important to have that property disclosure statement. It also somewhat protects you after the fact if there are some defects that you find that weren't disclosed on the property disclosure statement. There might be some way for you to kind of come back and get some sort of compensation through damages. It's not always the case. It really depends what it is. Consult your lawyer for these kind of things. But yeah, the PDS, property disclosure statement, is quite important for that kind of thing. What was the second part of your question?
I was just I just sort of maybe wanted you to touch on that real life example with the aluminum wiring.
Are you talking about my own?
Well, there was your own, but you had one recently too, where I know you had to have all the wiring remediated and
Oh yeah, yeah. So yeah, in that case, um, we were really lucky in that case because the vendor actually was okay with having it remediated before the possession date. Like I said, if the vendor doesn't want you doing any of the work before possession date, then you're kind of SOL, or you need to find an alternative lender that is okay with that kind of thing, right? An alternative lender could mean that you need at least 20% down payment. You might need to pay a lender fee, and the interest rate is going to be a little bit higher as well, right? So
yeah.
these kinds of property defects, it might not mean that you completely lose out on your dream home, but it might mean that you pay a little bit extra to get into that dream.
That's great. I want to move along to probably one of the most important things about this whole video. So we have our client, we've fully underwritten their pre-approval, their documents are up to date. We've verified the property and we're happy that there's no defects or we can mitigate anything that's on the property disclosure statement. We've kept in touch with their realtor and the client. Everybody's on the same page. And now it's time to write the offer. Number one question we get, do we have to write a financing condition? And this is really important because, as you know, our Winnipeg market is very competitive, and it's common to see 3 to 15 offers on a property. And I am just going to let you both opine on this, and I will also interject at the end. So, Colton, can you write an offer without a financing condition?
Well, I'm just going to start with that. We always recommend you include a financing condition. We like to say that we pre-approve you as clients. We don't typically pre-approve the property, right? So as Derek alluded to earlier, if there are defects that are found via an appraisal or something on the PDS, property disclosure statement, that a lender doesn't like, that could create some issues. So in the end, if you don't include a financing condition, are you protected then? If something arises, tip standardly not. So we always recommend including that just to protect you in case something were to just sprout out and create issues down the line. You'd always be protected, so we always recommend it, even if it is shorter in time. We always tell our clients to use one.
Derek, can you write an offer without a financing condition?
Uh, so the short answer is yes. The long answer is more towards what kind of Colton said. If you do, you're putting yourself at risk. Now, I think a really good question, is there any situation where we, as your mortgage broker, would say that yes, it is okay and you are protected to write an offer without financing condition? And what we tell our clients is if you have a plan B to just purchase that house without needing financing, then go ahead, right? You've got mom and dad with, hundreds of thousands of dollars in the bank that they can just throw your way if needed. Great. If you don't have a plan B and you absolutely need to use financing to purchase that home, then not having that financing condition puts you in a really, really risky situation. If you write that offer and it's accepted, and then all of a sudden you can't purchase the home because you don't qualify for any kind of financing whatsoever, which is rare. I will say that's very rare, but it can happen, right? So you would be putting yourself at risk of losing your deposit on the offer that you wrote to the vendor when you wrote the offer to purchase. And you could also be subject to damages if the vendor decides to sue for damages. Maybe relying on you to purchase their home in order for them to purchase a different, right? And now all of a sudden that puts their offer on that new home at risk, and they're being sued by that vendor, right? It could create this domino effect of litigation, and you don't want to be the person who started it.
And I agree with both of you. The answer is yes, but you really need to understand the contractual consequences of not being able to close on that house for any reason, whether your credit score changes, maybe you lose your job, maybe strike action will be taken by your employer, maybe you get really sick, maybe you're in an accident. There's a whole multitude of things that can happen between the time we've pre-approved you to the time you write your offer to the time you even take possession. So I think it's really important to have that conversation with your realtor and also let them explain the contractual penalties that could occur if you decided to take that risk. Because to be honest with everybody who's watching this, like I prefer when we get a clean offer just because we don't have a really short financing deadline. And that's going to wrap up to my final little topic about um, financing conditions and deadlines. I know when I talk to other mortgage brokers across the country, and we tell them here in Manitoba, we usually get 24 hours for financing and have to close sometimes within 2 to 3 weeks. They're just stunned that anyone can even do that because most other provinces will get a week to 3 weeks for financing and usually the closes are a little bit more extended. So we're always under the gun here. And I just wanted to maybe get a few sentences from each of you just stating why this pre-approval process is so important that we're so ready even before you write your offer.
Yeah, so I can start on that. Like
Yeah.
I kind of said earlier, it's super important to have all your I's dotted and your T's crossed. So when you do write that offer, we can meet your financing deadline, whether that's 24 hours or 3 days. We just like to have everything up front so we can meet the deadlines and make everybody happy in the end. Like Peter alluded to, our deadlines are often short. We get 3 days if we're lucky, and where that's sufficient time. But if there's any snags for whatever reason, it could get delayed, right? So it's a real pressure cooker for us, for the lender, for even the lawyer if there's a quick close, and the clients too, especially if they don't fully understand everything, which we do teach our clients going into it. But when they're in the crunch of the 2 day condition of finance, it's a lot of pressure on them when maybe that didn't have to be the case, right? So it's always something to consider.
Derek, did you have anything to add to that?
No, not really. I would just echo what Colton said. It can be a very stressful time for the borrower, right? And to make sure you've got everything ready to go with your mortgage professional, it as much as you can, it will help relieve that stress. You're already stressed out enough over all sorts of other things with the move and, getting your current home ready, maybe, or whatever it is you have to prepare for, aside from just the mortgage side of things, right? So the more prepared you can be with your mortgage profession, the less stressed out you're going to be once you write the offer and have this deadline all of a sudden to satisfy financing.
That's amazing. So I guess we can wrap this up. So again, we need to get an underwritten pre-approval, have everything checked from your income down payment to your credit history. And we want to stay in contact with our clients. Like with this is a very fluid process. It's not like you're pre-approved and then go buy your house. Like we need some involvement. We prefer to write a tailored pre-approval letter to the property that you're writing on so we can check the property disclosure for defects and look at the pictures of the listing to make sure there's no reason why a lender might not fund on that property. And whether you choose to write a financing condition or not, that's going to be a conversation that you're going to have with your realtor. Um, 90, where we can 99% probably guarantee that you will be able to fund on your home. However, a lot of things can happen or life happens sometimes that might get in the way. And of course, we'd like to take this opportunity to ask for your business or who do you know who might be looking for a mortgage pre-approval in the near future. They can contact us by phone or text at area code 431-482-2187. You can check out our website at www.mainstreammortgages.ca or send us an email at greatrates@mainstreammortgages.com. Thanks, guys. I really appreciate you taking the time to do this with me, and I hope this is the start of a really great podcast series.
Yeah, me too.
Perfect. Thank you.
Thank you.